So who are the participants in the financial services markets? Yes, we have retail banks. Yes, we have commercial banks. Yes, we have Islamic banks. Who else? Investment banks. What do? They help companies raise finance, either by borrowing, loans, or let me just put credit. Because when I say credit, it means either they can help you with loans or they can help you with bonds. Remember, credit is both loans from banks and bonds. When you issue bonds, you are borrowing from people. We know that. Or equity. Investment banks can help us issue stocks. Actually, if you go to a stock exchange and you want to issue stocks in a stock exchange, no stock exchange is going to talk to you. They're going to say, go find an investment bank. Let them come and talk to us. If we as the Tadawul Academy want to get listed, exchanges won't speak with us. Find an investment bank to represent you. We will speak to them. So we need investment banks to raise finance. We need them for trading and brokering. You will get a question on the difference between these two in the exam. Even though we are going to cover them again in chapter 3, it's good to know the difference between a trader and a broker. There are two important words we're going to use here. A broker is somebody who buys for you. Property broker, I want to buy a house. He finds me the house, earns his commission, and says goodbye. That's what a broker is. He is an agent. An agent who earns a commission. Whereas a trader, he's not doing it for somebody else. He's doing it for himself. We say principal. So principal is when you're doing it for yourself, your own portfolio. An agent or broker is when you do it for your customers. The difference between these two is highlighted later in this qualification. Most importantly, we have companies in the EU and the UK and in America which do both. We call these broker-trader or broker-dealer. Don't worry, we're going to see broker-dealers later in this qualification. They do both. They have their own portfolios, but if you want to buy stocks, they can buy it for you. They can also sell you from their own portfolio. If you want to buy certain stocks, they can sell it. They say the stock in the market is $100. How about you buy it from us? We have a portfolio. We'll sell it to you at 98. These broker dealers, because they have their own portfolios, because they are dealers, they are principals, they have their own portfolio, they can sell their clients from their own portfolio. So they can have both functions, broker and broker. Well, it's sort of a good thing they do for their customers. So we have our own portfolio, buy it from us at 99 point something instead of doing it in the market. By the way, in chapter 5, you're going to study regulation called MiFID. This is the EU regulation. And the new issues of MiFID, MiFID 2, concentrates a lot on this relationship, on how can you sell your client from your own portfolio. But it happens a lot. Investment banks helps you with treasury dealing, cash, forex, helps you with corporate finance. What is corporate finance? They provide you with advice on mergers and acquisitions. Any merger acquisition, there's always an investment bank in the middle, provide an advice on valuation. How much should you acquire this company for example?
MiFID abbreviate for?
Abbreviation for, you don't need it, but it's money in financial instruments directive. So, we also have challenger banks. These are smaller banks that are coming into the scene, usually fintechs, accepting deposits, internet banks. They don't have branches. They're purely online. They have excellent rates, usually higher than the rest of the banks. We call these challenger banks. Smaller fintechs, usually internet shops with no physical locations. We call them challenger because they challenge the big banks.
So this new bank, VO Bank, it's a challenger bank or?
We consider any smaller bank player who's coming into the scene, competing with the bigger players with better prices, usually are challenger banks. Custodian banks, they provide custody. Whenever you trade stocks and bonds or any securities, these stocks and bonds, they are not with your broker. They do not sit there. They are not on the exchange. They're actually sitting with the custodian. They safeguard, they safekeep these assets, these stocks and bonds. Their job is to safekeep, to safeguard these assets. They help you with proxy voting. You buy a stock, you might have the right to vote in the meeting. But let's say you're traveling. So you tell the custodian bank who is holding your stocks, go and vote for me. That's called proxy. Proxy means on my behalf. They help you with settlement, and we're going to study settlement in chapter 3 in more detail. Settlement of stocks. What is the process of buying and selling of securities? It goes through 3 stages: execution of the order, clearing in the back office or the middle office, and then it goes for settlement with the custodian. Don't worry about it. We'll get to it in chapter 3. But settlement stage happens with the custodian. Execution happens with the broker. You execute the order to buy a stock or a bond with the broker. Click buy, they execute it for you. But it has to go to the back office. It has to go through clearing and settlement. Settlement happens with the custodian bank. Custodian banks help you with asset servicing. Asset servicing means usually one thing: collecting coupons and dividends, collecting income. So these coupons you get on your bonds, these dividends you get on your stocks, these are credited to your account. And custodian banks help you credit that amount to your bank account. They help you with FX, foreign exchange. They provide you with statements and reports, and they can also help with stock lending and borrowing. Stock lending and borrowing, we don't cover it in this qualification, but there's another qualification from CISI called securities, just securities. One of the most difficult exams, used to be required in the UAE for brokers. Massive fail rate. Luckily, ESCA in 2023, they stopped it. But in securities, you will learn that sometimes a broker wants to borrow a stock. They don't want to buy it. They want to borrow it quickly and give it back to you in 2 days. So where do they go? They go to where the stocks are kept. They go to the custodian and say, lend me Microsoft stock for 2 days. I'll give it back to you. Custodians help pension funds, because they carry lots of stocks, also help with stock lending and borrowing. For the exam, what you need to remember for custodian banks is, what do they not do? Anything involving trading. They don't execute orders for you. They don't invest for you. They don't provide you with advice. They don't manage your portfolios. Anything front office, they don't do it. A custodian bank is reactive. Reactive, that means they wait for something to happen. They wait for an order from the exchange. They would say, Karim has sold Sonia stocks. Custodian bank would say, okay, fine. If Karim has sold Sonia, then Karim is no longer the owner. Sonia is now the owner. Let's change the ownership records from Karim to Sonia. That's it. A custodian bank will not act until they receive an order from the exchange saying this transaction has happened. So you see this dealing, investing, trading, advising? This is front office. This is sales. This is promotion. This is broker. This is execution. This is not their job. Please do not fall in the trap. That's why we put it in bold, in big letters. What they did not do is what's important for you to remember when it comes to custodian banks.
Any example of custodian bank, like for example?
Here in the UAE, MSMBD, FAB, I think Shua, we used to have HSBC, used to be custodian banks. Certain banks have a custodian department. Certain banks are fully custodians. In the UAE, there are mostly banks who have a custodian departments. Moving on with other participants, pension funds. We will study pensions in chapter 8. There are many questions on pensions, retirement schemes in chapter 8. But basically, it's a very simple idea. You save from your salary every month. It's taken, invested in a fund. When you retire, you take whatever you've been saved, and then you use it as income when you retire. That's pension. Pension funds receive contributions. Contributions are the savings of the employees. Don't worry, chapter 8 is all about pensions. We'll get to it. And then they invest it for the long term. They invest it in a very wide pool of assets. And then when the employee retires, they provide an income to the employee from the savings that the employee has been saving. Insurance companies are other participants in financial services. Insurance receives premiums, right? And then they promise you they would compensate you in case a certain event happened. In case there is an accident or a fire or a sickness, we will compensate you. There are 2 types of insurance: life insurance and general insurance. everything that is not life, don't worry, again, chapter 8 is all about insurance and pensions. We will look at the different types of insurance, life insurance, and different types of general insurance. Life insurance has two types, whole of life and term. Everything else falls under general insurance. There is no other category in this qualification. Only two types, life insurance and everything else which is not life insurance, everything else is general insurance. Stockbrokers, there are 4 types. The first type, and you are going to see this again in chapter 5. The first type is called execution-only stockbroker. This stockbroker, all he does is execute your order. You want to buy Microsoft stock? Click on the green button that says buy. Once you click buy, the stockbroker takes your order, sends it to the exchange. Kareem wants to buy Microsoft stocks. Execution only, that's all they do. The second type of broker has a bigger mandate or bigger activity. They execute your orders, but they also provide you with advice. So their license from the regulator includes an additional activity. That means they can provide you with advice, they can even manage your portfolio. That's the second type of brokers. The third type of brokers is called a robo-advisor. These brokers are usually, again, fintechs online. You have an app, you download it. An example of this is Sarwa in DIFC here in Dubai. You download an app, you answer a few questions, risk profiling, and based on it, the app creates your portfolio. We recommend 20% global stocks, 10% local stocks, 15% bonds. And once it creates a portfolio for you, it gives you an IBAN to transfer the money. Once you transfer the money there, they invest the portfolio for automated. It's all automated. These are robo-advisors. And they usually invest in ETFs, which are certain types of funds. We'll study ETFs in chapter 4. Robo-advisors are usually passive investments, and they invest in a certain type of funds called ETFs, even though some of them have started offering other products, but generally speaking, they invest in ETFs and they are usually passive. The fourth type of brokers are brokers which are dedicated to institutions. Again, a very popular question in the exam, what's the difference between a financial services company that offers services to institutions versus retail? The needs of the retail are different than the needs of institutions. Usually this is classified under 3 categories. It's very important for the exam, remember them. The first one is knowledge and experience. Institutions have more knowledge than retail. If a bank wants to deal with the bank, they know they are dealing with somebody who understands everything. 2, volume. Institutions trade and deal in bigger numbers, way bigger numbers than the retail. And because they deal in bigger numbers, these brokers will have to give them a special price, so discounts. So institutional brokers, the fees are lower because the volume is higher. That's the usual difference between institutional brokers and retail brokers. More participants, saving institutions. These are usually new to us here in the Middle East because we don't have them. They are called mutual banks. Mutual, the word mutual here, it means that the bank is actually owned by its customers, mutually owned by its customers. Every time you open an account, you deposit or you take a loan, you are a customer of the bank, you own a piece of the bank. That's why we say they are owned by the account holders. In the exam, if you see they are owned by the depositors, that's wrong. Because they're owned by both depositors and borrowers. Anybody who's a customer has a piece of that bank. They're owned by their account holders. They have different names. In America / Canada, they call them credit unions. In UK / Australia, they call them building societies. And in Spain, they call them cajas. And yes, sometimes these names come in the exam. What do you call a mutual fund in America or in the UK or in Australia? They do come. You have to memorize them. Now, sometimes these mutual banks might say, you know what? We want to convert from a mutual bank to a regular normal bank. which is like owned by shareholders, right? This process of converting from a mutual bank, which is owned by the customers, to a regular bank, which is owned by shareholders, this process is called demutualization. It's the process of converting from a mutual bank to a regular, normal bank. To be honest, many customers prefer dealing with mutual banks. Because they are owned by the customers, they give better rates on deposits, they give better rates on loans, they have better customer service, they have more ATMs and branches. Why? It's because you are owned by a customer. You have to provide him with a better service. In rural areas in America and the UK, they don't deal with these big name banks. They prefer their mutual banks.
The risk of the money, there is regulation.
Who?
All these mutual companies.
Mutual banks? Yeah, yeah, of course. They fall under the same central bank. It's just that their business model is different than the other banks.
They are moving to a bigger bank.
Growth. Because they want to list stocks in the stock market. They want to raise capital in the stock market. They want to grow. But sometimes even mutual banks can be massive. In 2008 financial crisis, one of the biggest collapses, we only heard about the collapse of Lehman Brothers or Bear Stearns, but there are other big banks that collapsed. Washington Mutual. Washington Mutual was one of the banks that collapsed, one of the major banks. It was a mutual bank. It collapsed in 2008. So what is wealth management? Simple. Providing services, tailored services to high net worth individuals, managing their investments, giving them loans against their portfolios, helping them with planning their taxes, and estate planning. What is estate planning? Let me highlight these two. So I said tax is important to remember, but also second thing to remember is estate. Why? Because we live in a world that's mostly Muslim. And in Islam, you don't really get to decide who takes your money when you die. We have Sharia, right? Sharia says, okay, your wife gets so much, okay, your brother or son, blah, 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 blah. So we don't have to worry about estate. It's all planned according to Sharia law. But in other regions, estate plan is incredibly important. You want to divide your estate, your inheritance. Estate is an, sorry? After his, of course, yes. Another name for estate is inheritance. Inheritance planning. Some people want to leave some of their money for charity, some for their businesses, some for their children and wife. Some they don't want to leave it to anybody. Just give it away to whoever you want. We will study estate planning in chapter 8. It's part of the pensions and insurance chapter. So keep two things in mind. We live in a region that doesn't have tax, that doesn't plan its inheritance. But these two things are part of wealth management. So what is a high net worth individual? Every bank has different profiles. In the exam, you have to memorize CISI's numbers. Mass affluent, anybody with over $100,000. High net worth individual, over $1 million. Very high net worth, over $5 million. Ultra high net worth, over $30 million. These are the numbers that you have to memorize, not the numbers that your own bank uses. When you manage the portfolio of your customer, you manage it on two bases. Either on discretionary basis. Discretionary means you, as a portfolio manager, you have power. Discretionary means power to the manager of the portfolio. He has the power to buy and sell. Yes, you agree with the customer what he wants. I only want investments which are Sharia compliant. And please only invest in the GCC. Good. He gave me the framework. But I now have the power to buy and sell on his portfolio. Discretionary power. The other type of relationship is called advisory only, sometimes called non-discretionary. That means I don't have power. All I do is provide my customer with advice. He decides whether to buy or sell. He implements the buying and selling himself. All I do is provide advice, and the client is the one who makes the actual decision. not me as the portfolio manager. And finally, to end this chapter, we are just going to give you a quick cycle about what financial planning is. This is going to be covered in more detail in chapter 7, investment advice, which used to be chapter 5 in the previous edition. It used to be called fiduciary duties. Now it's called investment advice. So we start with establishing a client relationship, meeting with him, inviting him for coffee, pampering him, calling him the best of names, the most handsome man in the world. Just have coffee with us, collect clients' information, KYC, risk profiling, give us your bank statements, let's understand your financial profile, analyze his status. Are you in debt? Are you able to take risk? Are you able to go into this product? You develop solutions. We believe real estate is the best thing for you. We believe crypto is good for you. Develop solutions, implement them, actually build a portfolio, and then monitor it. And then you review the client situation. Why do you continuously review the client situation? At least annually. Why? Because it changes. Sometimes the client might be poor, next year he might be rich, and vice versa. So you have to continuously, in this exam, if you're asked, how often do you review your client? At least annually. Of course, every country has its own regulation. If you've done the UAE financial rules and regulation, you understand that sometimes if the portfolio is leveraged, if the portfolio includes some certain stocks, you have to review it probably every quarter or report every month, for example. But in this qualification, at least every year, you have to review the client's situations. Yes.